Okay, dear students, good evening to everyone. Let's start the class. I hope everyone can see the screen. And we have shared, and the question which we are going to discuss, the name is Gini Company. And this question came in March, June 23. So obviously from the recent attempt, I would say. Okay, here comes the question. Let's read the requirement first. Requirement A. Okay, students, the requirement A says calculate expected NPV of LP 500 project and comment on its financial acceptability. Whenever the question says expected NPV, it means you will have probabilities information in the question. One, examiner is asking us to calculate expected NPV, and the second is comment on its financial acceptability. So financial acceptability comment is extremely easy. Simply, if expected NPV of the project is positive, simply the project is financially acceptable. By chance, if you get the negative NPV, assuming, which is incorrect, but still then you have to write that expected NPV, for example, it is negative, that is why project should be rejected. You will still get 1 mark for writing the correct decision. Even there's a possibility you might be numerically wrong. So never forget one thing. If we are getting a positive NPV, project is acceptable. We are getting a negative NPV, so simply we will not accept the project. Part B, briefly discuss how your decision in part A will help Jimny company to achieve their primary objective. Student, please listen it nicely. The primary objective of financial management is to maximize the wealth of shareholder. Repeat. The primary objective of financial management is to maximize the wealth of shareholders. Obviously, positive NPV means that is the amount which this project is going to give the benefit to the entity. So obviously, when the project is beneficial, so automatically that will contribute to increase, to maximize the wealth of shareholders. Just for 2 marks, we have to discuss this. Then we need to discuss limitations of using probability analysis. You have to just discuss the limitations. While discussing the limitations, if you are technically correct, you will get marks. It is not necessary that you have to exactly write what examiner has written. So we'll discuss if I just give you a little idea about part 3. For example, limitations of using probability analysis. Now, number one limitation is whatever probabilities examiner has given us in the question. Number one limitation is justification of the probabilities which examiner has given is questionable. You cannot justify them. There's no guarantee that whatever probabilities examiner has given us, number one, they are accurate. Second, there's no guarantee same thing will be repeated in the future. So justification becomes questionable, plus there's no guarantee. For example, let's say in the past we have decided there are 30% chances, just an example, 30% chances event one will happen, 40% chances event 2 will happen, and again 30% chances event 5 will happen. There's no guarantee that these probabilities are correct and these probabilities will be repeated. There's no guarantee at all. Plus, whatever outcomes probability analysis gives you due to expected values, practically that outcome will not come at all. And plus this probability analysis, they do hide the risk as well. What sort of risk? For example, let's say there's a variable cost of, let's say there are 10% chances their variable cost will be 80. And let's say there's 50% chances variable cost will be 40. And there's 40% chance variable cost will be 30. It means If you calculate expected value, it will be different. But don't forget, there is a 10% chance that variable cost could be 80. There's a possibility the project is giving us a positive NPV because we are working on expected value variable cost. If we just go for that 10% chance and instead of working on expected value and taking whatever the variable cost we have calculated, if we work on the variable cost 80, there's a possibility same project might produce negative NPV. So we will discuss all this, don't worry at all. Let us first read the data. Gini Company is a listed company that manufactures innovative products for telecommunication industry. Gini Company has just developed a product called LP500, which is expected to have a project life 4 years. So first important point is project life is 4 years. Okay. Gini Company management has decided that sale price for LP will be $90 per unit. As analysis, as anything higher than this will dramatically reduce expected sales volume, which is currently forecast to be 20,000 units per year. The variable cost of LP 500 includes the cost of bought-in component X22. The price of X22 has been volatile due to the supply problem with the manufacturer, and consequently the variable cost is at present uncertain. The management of Gini Company has made the following estimation for the variable cost. Variable cost could be $40 per unit, probability is 20. It could be 50, probability is 40%, 60, 20%, 70, 20%. Incremental fixed cost. Variable cost is of course always relevant. Incremental additional fixed cost is also relevant. Okay, now all of the above figures are in current prices. Students, whenever examiner says information given is in current prices, then we incorporate the inflation from the first year. Whenever the question says the prices are in current price term, we always incorporate the inflation from the first year. Sale price inflation is expected to be 5% per year. Variable cost inflation and fixed costs both are 3%. Okay, new plant and equipment costing 1.5 million. That is your initial investment will need to be purchased at the start of first year of operation. Expected to have residual value is 125 in nominal terms. Nominal terms means with inflation at the end of year 4. Gini Company pays corporation tax at 20% and tax is paid at the end of the year, following the year in which it relates. Can I say there's a delay of 1 year? Tax is paid with a delay of 1 year. Additionally, working capital 100,000 will be required at the start of the project and working capital will increase by 3% per year. So in this question, there's an incremental working capital requirement as well. Okay, one more thing, the company can claim tax allowable depreciation at a 25% per year on reducing balance basis. Fine, we have to calculate tax saving from capital allowances as well. Nominal after tax cost of capital is 12%. Why examiner has given us nominal? Because we have to convert real cash flows to nominal. So of course, once we'll be having a nominal cash flow, so cost of capital will have to be nominal. Students, the numerical part, obviously you have to deal with the numerical part on the spreadsheet. So let's click the spreadsheet. Here is the spreadsheet. 2 minutes. Just why We cannot see both the screens. Okay, let's see. Let's try. I'm just increasing the font size. Okay. We are doing part A, and we are calculating expected PV of NPV. Project Life Examiner has given us the 4 years. I hope everyone can see this spreadsheet. Yes or no? Please reply. Because I should not be the only one who can see this screen. And let me see the recording. Yes, it is going on. Yes, okay. Project life is 4 years, but impact will go for till 5. Student, why impact will go till 5? Even though the life is 5 years. What is the reason? Yes, tax is paid with a delay of 1 year. Let us show the workings. Working 1. Let's calculate sales. Time 1, 2, 3, and 4. Let's see the sales volume. Student examiner has given the sales volume. If I ignore 3020,000 units, current selling price is $90 and inflation rate for the selling price is 5%. Sales volume, I'm ignoring 3 zeros is equal to 20. Every year, the sales volume is 20. Option of drag is available in exam. Selling price per unit is 90. And again, it is same. But of course, we have to incorporate the inflation as well. Inflation rate is 5%. Inflation rate is 5% per annum. I'll take 90. Multiply by, can I say 1.05? Then you can do this. Let's go back. Try to make a formula. We'll take 90. Multiply by 1.05, then power 1. It is 94.5. Now the option of drag. We took 90 into 1.05 power 1. So students, let's see what is the value in the last year. Here we are getting 99.225. So, okay, fine. Now we can easily calculate the sales. Let's calculate sales. How will we calculate sales? Can I say we'll take the sales, multiply by selling price. Again, the option of drag. Only you, we are using the shortcuts which are available in exam, okay? I hope this calculation is clear to everyone. Yes or no? Quickly reply, please. Student, the working of sale is clear to everyone. Yes or no? Can you please reply on this? Yes, it is clear. One student is saying. What about others? We are ignoring three zeros. Initial investment. Student, if you recall, the initial investment is minus 1500. Now, sales, simply working one. We have to create the link. After that, again, the option of drag. But let me tell you one thing. Let's see. It's directly 200. It's okay. Let me tell you one thing. Student, when you'll be practicing even on ACCA CV platform, and if, I hope you have given the papers as well, that CB platform as well as the main spreadsheet when in examination hall, it works very slow like this. It is far more slower than the normal Excel which we use. So it means while solving the question, you have to have little bit patience. So just 1 minute break because Azan is sounding right now. Let me pause the video. Okay, students, let's go for working two. Now we have to calculate expected value of variable cost first. Let's show it here. We have to see the probabilities. Students, the variable cost could be 40, which is having a probability of 20%. It could be 50 with a probability of 40%, $60 with a probability of 20%, even even $70 with a probability of 20%. Okay. So variable cost could be 40 with a probability of 20%, plus variable cost could be 50 with a probability of 40%, Plus variable cost could be 60 with a probability of 0.2. It could be 70 with a probability of 0.2. What are we getting? Why it is not giving us the result? Let's try here. I don't know. 40 multiplied by 0.2 plus 50 multiplied by 0.4 plus 60 multiplied by 0.2 plus 70 multiplied by 0.2. So the expected value is 54. Okay. What was the inflation rate for the variable cost? I think it was 3%. Inflation rate for the variable cost is 3%. Time 1, 2, 3, and 4. Sales volume. Sales volume, we know that it is 20. Variable cost, we have already calculated. So why it's not working the option of drag? Just take this. So in exam student, if any of the function is not working, you have to do little bit work manually. Manually means the way I am doing. You can go for copy paste. Now variable cost. Inflation rate is 3% per annum. We'll take 54 multiply by 1.03. Take power 1. So I hope it should work. If not, then we'll be doing it manually. If I hope it is 59, and then we have, let's see the total variable cost. We'll take sales volume. The entire information. Okay, it's here. Cell. Okay, here's the variable cost. This much is okay. Around there. Okay. Now, students, just copy paste for the variable cost. You have to show the reference of the link. You have to create the link as well as where it is possible. Plus, you have to show the reference of the working as well. Variable cost with negative. So let's take variable cost. Simply the option of drag. Okay. So students, we have calculated sales as well as variable cost. Now, can I say additional incremental fixed cost we can directly calculate? Let's see what was the amount. Incremental fixed cost is 300,000 per year. Incremental fixed cost is 300,000 per year and the inflation rate is 3%. Simply additional fixed cost inflated by 3% per annum minus 300 from the first year. This is the one. Minus 300, then we have 3%. 1.03 and power 1. Power is here. Minus 300 multiply by 1.03 power 1. So we are unable to create the link. So let's do it manually. 300 into 1.03. Now, second year, I'll take this, multiply by 1.03. Third year, just take this, multiply by 1.03. So students in exam, if any of the shortcut is not working, please, you should be mentally prepared for the plan B. 1.03. So we have calculated the fixed cost as well. Can I say now very easily we can calculate taxable profit tax values as well. Two things I've already mentioned in the regular classes also. Always try to deal with the tax saving from capital allowances after you have calculated the tax payments, because if you are in considering tax saving from capital allowances before you have calculated the tax payment, then your taxable profit value will become incorrect. Your tax payments will be incorrect also. And can I say the nature of the working capital is current asset? We do not pay tax on current assets. That is why always deal with tax saving from capital allowances as well as working capital after you have calculated the tax payments. And also inflow of residual value we always show after we have calculated the tax payments, because we do not pay tax on residual values. I hope it is clear to everyone, these concepts. Yes or no, students? Okay. Taxable profit, just use a sum formula. Then use the option of drag. Can I say after taxable profit, you have to apply the tax rate, but tax payment, they will come from the second year. Tax payments, they will come from the second year. Student, from here onwards, we will start with a break of around 23 minutes to 25 minutes because there's a prayer time. So I will resume the class within 25 minutes, inshallah. Before resuming the class, I will drop the message in your WhatsApp group. And meanwhile, you people have time. You can please try to complete the question. Let me pause the recording. Okay, students, let's resume the class. Thank you for, I would say, waiting. Taxable profit we have calculated. Tax rate is 20% paid with a delay of 1 year. So very easily we can calculate now. Tax payments at 20%. And we'll start from the second year. Minus, because it is a payment, multiply by 20%. Let's see the option of drag. I think it should work. If it does not work, so obviously then we'll be solving it manually. Mm-mm. It's not working. Let's see. We have to go till year 5. Control Z. Just take this. Minus, then 20%. Now, students, tax saving from capital allowances and working capital, we will deal after this. So far, we have done 2 workings. Now, let's go for working 3, in which we will show tax savings from capital allowances. Tax savings from, you can say tax depreciation is the same thing. Time 1, 2, 3, 4 and 5. Why 5? Again, there's the same reason, because tax is paid with a delay of 1 year. Your first tax payment is in second year, so your first tax saving will also rise in the second year. We are ignoring 3 zeros. Capital allowances. Capital allowances. By using 25%. Let's say written down value. Investment amount is 1500. Multiply by 25%. Now, student, if you recall for the second year, you can do one thing. Just take first year capital allowance. Can I say multiply by 75%? That will give you the tax depreciation for the second year or capital allowance for the second year. For the third year, just take this, then 75%. In the last year, student, if you recall, in the last year, we have to take the balancing figure. Initial investment minus all the depreciations, all the capital allowances which we have already claimed. Oh, oh. And we have to minus the residual value as well, scrap value. And scrap value, they have given us 125. So in the last, excuse me, in the last year, the balancing figure is 507. Okay, now simply we can easily calculate the tax saving from capital allowances. Tax savings from capital allowances by using tax rate 20%. Saving will arise from the second year because we are paying tax with a delay of 1 year. Let's see the option of drag. Will it work? Oh, it's working. The option of drag is working here. So that's great. That was working number 3. Tax savings from capital allowances or tax depreciation is the same thing, please. Working 3. And we will show tax saving from the second year. What is this? Tax saving, tax saving, tax saving is this. Enter. It should be there. Yes. Now let's see the option of drag. Logically, it should work. But if it does not, then. So option of drag is working, student. You can see that. Now we have to show working capital and the recovery, because if you recall, there is a concept which we have discussed many times. Working capital can never be consumed. Whatever we are investing in working capital at the end of the project, it will be recovered. So working capital simply can never be consumed. Or whatever we are investing in working capital, it will be recovered. So that's going to be working 4. Working capital will also increase by 3%. Working capital will also increase by 3%. Uh-oh. Working 4. Working capital and recovery. Time 0, 1, 2, 3, and 4. Working capital can never be consumed. So whatever we are investing at the end of the project, which is T4, whatever we have invested, it will be recovered. Let us first write working capital needed. Inflated by 3% per annum. Let us see in the question. How much was the working capital initially? Working capital, student, you can see that additional working capital is 1 lakh and also required at the start of the project. So logically, we need working capital. Working capital is 100,000, but that 1,000 will increase by 3% inflation rate. So no issue at all. Just let me show you. 100. Basically, it will be start of T1. Then this 100 will increase by 1.03. Then we will take 103 multiply by 1.03. Then again previous year into 1.03. Now working capital and recovery. Now students, can I say logically for T1 you have to make investment at T0 and we have to show this as an outflow. Then for T2 you have to make investment at the end of T1. For the start of T2 you have to make investment at the end of T1. And working capital requirement has increased from 100 to 103. It means that there's an additional working capital requirement of 3. How will you calculate? You can just do this minus, then simply bracket T2 minus T1 minus bracket T2 or T3 minus the previous year T4 minus T3. Can I say in the last year, whatever we have invested in the working capital, entire amount will be recovered, and this much we have invested. Working capital can never be consumed. Whatever we have invested in the working capital, it will be recovered at the end of the project. That is working 4, I believe. Working capital. And we have to show this from 0. Again, the option of drag should work. Yes. Can I say now we can easily calculate the total cash flows? plus the initial investment. This plus initial investment, then I'll take your question. Don't worry at all. What is the question? Okay. Yeah, we have to show the residual value. Yes. Thank you. We have to show the residual value. Thank you for the reminder. Residual value. Residual value is 125. Okay. Plus a redo 109.27. How did we calculate? Let's see. Come here. This one, T3 inflated by 3%. And here I just did the copy paste, nothing else, because at the end of the project, whatever we have invested in the working capital, everything will be recovered. Is it clear? Just the last year value I've taken as it is. Because working capital can never be consumed. Is it okay? Should we go ahead? Okay. Now let's go for total cash flows. Plus we have to take the initial investment, which we know that is 1500. Now, let us try to use a sum formula. We'll take the column of row of residual value, working capital, tax saving from capital allowances, tax payment, and taxable profit. That's it. At taxable profit, you have to stop. Now, again, the option of drag should work. Now, students, cost of capital they have given us. It was, I believe, 12% nominal. Cost of capital is 12%. You can see that. Cost of capital is 12%. Let us first check that NPV shortcut is available in this CB platform. Oh, yes, no. Let's see. Wait for a minute. NP, in fact, expected value of NPV. Let me check. NPV function. We'll take discount rate, comma. Just take all the cash flows from here. Bracket close. Then plus the initial investment. Initial investment plus investment in working capital at time 0. So the final result, let us see. Student final result, we are getting 78.2134. Can I say the expected value is positive? And positive expected value means project is financially acceptable. I hope this NPV shortcut function is clear to everyone. Can you reply on this, student? Is this clear to everyone? Okay. So NPV of the project is positive, so that is why project is financially acceptable. Positive NPV means project is financially accepted. I hope entire calculation, presentation, everything is clear to everyone. Now let's come here for part B. Student, for part B first, you need to listen to me carefully. What to write, way to write. Number one, the answer of part B, you should give by using word processor, MS Word. What do you have to write? I'm just explaining so you can write in your own wordings in order to save the time. Part B1 says briefly discuss how your decision in part A will help Gini company to achieve their primary objective. Now, let's read the question. Look at the first line. Gini company is a listed company that manufactures innovative products for the telecommunication industry. Fine. While answering B1, you have to just simply write one thing, that primary objective of financial management is to maximize the wealth of shareholders. Number one. And number two, Gini company is it's not a non-profit making organization. So that is why positive NPV will contribute to increase the wealth of shareholders. Repeat, the primary objective of financial management is to maximize the wealth of shareholders. Simply you can write this. Primary objective of financial management is to maximize the wealth of shareholder. Over here, project is having the expected value. Expected value of the NPV is positive. So therefore, this positive NPV will contribute towards maximizing the wealth of shareholder. Again, acceptable. It's okay. If someone is saying that Gini company is a profit-making company, so they have the objective to increase the wealth of shareholders, and expected value of NPV will contribute to achieve that objective. Student B1 discussion is clear to everyone. Just please tell me yes or no. Part B1 is clear to everyone. And one student says no. So students, can you tell me what is the object? If you are a profit-making company, what is your objective? You want your shareholders' wealth to maximize or reduce? Please reply. If your company is a profit-making organization, your company is not a non-profit company. So what is your objective? To maximize the profit or not? Maximize. So what do you think? Positive NPV will contribute, or will it positive NPV will contribute to maximize your shareholders' wealth, or will it reduce the wealth of your shareholders? Positive NPV means something beneficial. So what do you think? Will it contribute to maximize the shareholder wealth? Yes or no? Please, can you reply quickly? Student, I'm waiting. Positive NPV. What do you think? Obviously, positive NPV will contribute to maximize the wealth of shareholders. So this is what you have to write for part B, 2 marks. Students, again, an issue? Let me see the question of the students. For non-profit businesses, we are not doing NPV calculation. Right now, the business which is in front of us, it is a profit-making company. Is it clear right now? Yes or no? We are not doing this question for non-profit. Okay. Now, point number B2 is important. Discuss three limitations of using probability analysis in deciding whether or not to proceed with LP 500. That should we proceed with LP 500 or not? We have to just discuss how many limitations? Three limitations. Now, please try to understand one by one. And again, you should be writing in your own wordings to save the time. Please, can you see this variable cost per unit probability? There's a 20% probability variable cost is going to be 40. There's a 40% probability variable cost will be 60. There's a 20% probability variable cost will be 70. Am I right? This is which you can see in front of us. Okay, now. So there are, according to the question, there are four possibilities. That variable cost could be 40, 50, 60, and 70. Now listen carefully. Actually, how do we calculate probabilities? Probabilities are calculated from the past events. Probabilities are calculated from the past events. Assuming from the past event, company has calculated these probabilities. Can I say still there is no guarantee that this pattern of probabilities will be followed in the future? How do we calculate probabilities? From the past events, which has occurred many times. Even the event which has occurred many times in the past, there is no guarantee the same pattern will be followed in the future. Student, is this clear to everyone? How do we calculate probabilities from the past when the same event happens many times? Then we get probabilities. But there's no guarantee the same pattern will be followed in the future. First point, is it clear to everyone? Then we'll go to another point. Students waiting. Okay, first point is clear. Now listen the second point. Student, while solving the question, we have calculated the expected value variable cost 54. Am I right? When we calculated the entire NPV, we used expected value of variable cost 54. Okay. Now try to understand the outcome of variable cost which we have used. Look at the probabilities. Logically, the outcome of expected values of the variable cost which we have used, that event will not occur according to the probabilities which examiner has given us. Either logically, either variable cost will be 40, 50, or 60 or 70. Logically, it cannot be 54. Just an example, if we just throw the coin, if we are doing a toss by using a coin, either there is going to be head or tail. You will not have the combination of both. So another limitation is the outcome of expected values by using variable cost will not occur. So we have utilized the variable cost 54, even though that will not occur according to the probabilities which are given in the question. Student, the second point, is it clear? Yes or no? Please reply. Students, I'm waiting. Okay, now. Now, there's one more issue. What is that? Of course, we have calculated expected value of NPV by using probabilities. Now try to understand. The expected value variable cost which we have used by using these probabilities. Basically, expected values, listen it carefully. Expected values, they hide risk. How do they hide risk? We have used the variable cost 54. Can I say variable cost could be even 70? It has just a probability of 20%, but still there are 20% chances that variable cost could be 70. Now try to understand. Instead of 54 for the same project, if your actual variable cost turn out to be 70, then there's a possibility that you might not have a positive NPV. Same project could result in the negative NPV. So what I'm saying, this expected value analysis actually hides risk. While calculating expected value of NPV for this project, we have used variable cost 54, even though there's a possibility, there's a probability that variable cost could be 70. Chances are 20%, but there are chances. So if actual variable costs turn out to be 70, then there is a possibility instead of positive NPV, NPV could be negative, or it could be negligible, insignificant positive. Student, third point is clear, yes or no? Students, I'm waiting. Okay, now there's one more limitation. What is that? You have to see the attitude of management towards risk. Try to understand attitude of management towards risk. For example, if you look at the data, there's a 20% chance variable cost could be 40. There's a 40% chance variable cost could be 50. Now stop. It means altogether there is a 60% possibility that your variable cost is going to be less than 54. Try to understand. The data says there are 20% chances variable cost could be 40. There are 40% chances variable cost could be 50. While calculating expected value NPV, we have used 54. But there's one positive sign. The positive sign is there's a 60% chance. Actually, your variable cost is going to be less than 54. It means the same project will produce even a higher NPV than what we have calculated. It means we have to see the attitude of management towards risk. For example, if management is having a positive attitude, they are very optimistic, then they might be thinking that, okay, we have used variable cost 54, but still there is a 60% chance that variable cost could be less than 54. If they are very optimistic, they might be thinking like this. But if they have the attitude towards risk, for example, they don't want to take such a high risk. If they are pessimistic, then they might be thinking like this. There's a 40% chance that variable cost could be even more than 54. And that will deteriorate their NPV. It means attitude towards risk is also extremely important. That how your management, what is the attitude of your management towards risk? Is this clear to everyone? Yes or no? Because there is a 60% chance that your variable cost is going to be less than 54, but there's a 40% chance it could be even more than 54. Okay, now students, I hope the presentation, how to solve on the CV platform, that presentation should be clear to everyone. Number one, we have utilized all those shortcuts which are available in exam. Now, student, please listen, and what you are supposed to do, that is very important. I want everyone of you and those that are watching the recording of this video, please immediately after the class do read the answer of part B from the Kaplan kit. You have to read the answer at least 2 times. In the answer, theoretical part, if you have any confusion in any paragraph, please do ask in your relevant WhatsApp groups. I will inshallah reply. Plus one more thing, please, you have to practice on the CV platform. We have uploaded all 3 questions at ASA CB platform. So I want you that please rest of the 2 questions you people should try on the CB platform. Now in the next class, either we'll be doing one of the question from the remaining 2 questions, or if I have already solved those questions, then I'll upload the video lecture on those questions plus new questions I'm going to share in your WhatsApp group, in the WhatsApp group, of course. But student, please, you have to practice a lot on the CB platform. Your practice matters a lot rather than mine, because you are the one who has to give paper. So you have to make sure that your typing speed should be decent. You have to make sure that you should be familiar with all the shortcuts. So student, the last minute of the class, is there anything you want to ask, you want to say? Please go ahead. Before I end today's class, is there any question? Students, I'm waiting. Let me just pause the recording so that. Let me just a minute. I hope everyone can see the Excel. Okay. How to use the NPV function on Excel? That's a question. Okay, time. Just a minute. Okay, fine. Time. Zero, 1, 2, 3, 4, and let's say 5. I'm just writing total cash flows, okay? Just to show you the shortcut. And I'm assuming total cash flows, please. Minus 1600. Let's say positive 450. All these cash flows, I'm just assuming, please. 400. Let's say 600. 700. And let's say minus 20. Again, I'm repeating, I'm just assuming these cash flows just to show you the NPV shortcut. Cost of capital. Let's say cost of capital is 12%. Now you can directly calculate NPV, or you can also calculate NPV in two steps. It's up to you. If we are calculating NPV in one go, I'll show you that NPV. Now come here, is equal to NPV. Take the cost of capital, then comma. Start from T1. Shift and then right arrow. Go till the end. Close the bracket. Then plus take this T0 cash flow. Let me bring this into numbers. So we are getting a negative NPV 18.75. Is this clear to everyone, students? Or there's one more presentation. Let me show you that also. You can calculate present value from T1 to T5 first. Okay. Again, by using NPV function. Just take cost of capital, comma. All the cash flows, bracket close. Now, less initial investment, which is in our example negative 1600. Now, NPV, take this. I hope it is clear to everyone. Both the present, but please, you are supposed to use any one of them rather than both of them. Is this clear now? How to use this shortcut of NPV? So either go for the first one. In first one, you're just directly calculating NPV. In second one, you are showing this into. I hope it is clear. Okay. So students, thank you very much. See you all inshallah in the next class. Do give the feedback on today's class in your respective WhatsApp groups.